Do you see the domestic money panicking at all? Because it's been super resilient, I mean, surprisingly resilient. Do you see that getting shaken for some reason, or because there are no other opportunities other than equity?
I think it's a bit of both. That a lot of money which goes to real estate clearly is not going to be heading there. I don't think there is a case for gold on an ongoing basis, and also now given the schemes and the options available there. If rates are actually going to fall, you have no great advantage now going and sitting in fixed deposits or stuff. And I'm guessing that people now have this semblance that really equities is a place where I can make long-term wealth creation for myself. And again, we are talking of $1 billion a month inflow in India.
Yeah.
I mean, in a country of whatever $2 trillion with 500 billion of saving, we're talking of 10 or 15 billion dollars of equity inflows, which is like 2-3% asset allocation. So it's really still a trickle. We waited for long, 15-20 years in my career. I waited where the allocation become more like 15-20, given that the age profile of India is 20-25 years kind of demographic. It seems like a tall, ambitious order, but I'm sure in my lifetime I will see India doing a 15% allocation to equity on hopefully by then $1 trillion or $2 trillion of savings. And our asset managers will become the way we look with awe at the American funds with $1 trillion of assets. And I've seen funds there which have gone from during my career from less than 100 billion to excess of $1 trillion, $2 trillion. So it's not impossible, it will happen. I don't think the current trend is something which turns easily. It may not continue, billion may not become 2 immediately, but it's not, I don't think it's becoming $500 million also in a rush.
What's the phase we are in? It's not like a bull market, it's not a bear market. This middling, ambling along. So
look, bull markets get created on easy liquidity and sentiment. Liquidity is tightening in the world, and it's an extension of an aging bull market. It's a tired bull market in the West. And my sense is it ends badly in the West because these currencies have no business to be where they are. If you put $20 trillion of excess money supply into the world and there are no consequences for your currency and you're really ex-growth and there has been no change in their real living standards in bulk of the OECD, normally these currencies should have adjusted. It adjusts only if there's new leadership, and that new leadership had to be picked up by China, India. China shows some signs of it having the guts to now say we will float our currency and we will play a game of our own making and our own choice. India is still trapped, I think, in our old thinking of this great inflation differential argument. But in a world where those guys are going to deflate forever, are you saying that they will be in deflation and recession and we will keep depreciating our currency? Because whatever we do, you're not going to get an engine of exports kickstarting and getting us to supply from here. You can take the currency to 100. It's not going to change materially for us over here. And with manufacturing being 15-17% of GDP, it's not like we have that much surplus to export or we have that kind of scale to export as well. And it's really, like I said, software services, which is a $10 billion profit pool for India on whatever base of $100 billion. That's really the business or tourism, things like that, which will be the panacea for us.
What do you think, where do you think the serious money will be made in the next 4 or 5 years? I mean, is it consumption, is it financials, is it capex? I mean, talk about the domestic themes.
I'm not that hopeful about capex cycle over here, because if there's so much surplus capacity in the world, it's like if the agricultural age ended, no one then went into farming after that. And in some sense, the manufacturing age, given the excess capacity for almost everything in China, and B, the advent of now what we call AI and robotics and 3D printing, changes the rules of the game in manufacturing. So if I were a manufacturing guy, I would be really hesitant to commit large capital today. Plus, the rules and the regulations are changing, so let's see where it settles. And then we play the game there.
You're saying the rate of getting obsolete
is very, very fast. Like even if, say, the best sector in India in manufacturing in some sense in terms of ROE has been automobiles. If the auto people now see there will be self-driving cars 10 years later, there may be completely different engines and may not be oil driven. That changes the rules of the game. So today it's the old manufacturers coming, setting up capacity in India to address this market, rather than saying let's now develop some new technology to play the next rules of the game. So as followers in manufacturing, I'm not certain we change completely. And you take our leaders, like if RIL is in some sense moving from oil to telecom, and really playing the whole consumer internet space with financial services, media, all of that thrown in over there. It suggests a certain mindset among the leaders as well. So I'm less sanguine on capex coming from private sector. It will come from the public sector inevitably, and infrastructure is a big area and big opportunity there for people to make money. When you talk of exports, really we don't have a big manufacturing base. We don't really have a lot of surplus on agriculture to export. That leaves you with services. And services, one is outward, where we were sending our people to Middle East or IT to go and service the West. Healthcare may be a very large area, and tourism, I think, is completely undercalled in India. So these would be the areas to pick up. And at some point, I think over the next 3-4 years, you get a windfall, because as the world moves away from oil on the energy plate, that's really been the bottleneck for India on the current account. And if that changes and you start getting these inflows, that changes the rules of the game on the rupee front. And my sense is only when rupee strengthens and you get purchasing power, then the average Indian goes and this whole consumption economy kickstarts. Because while you've talked of earnings not coming for 2-3 quarters, I'm more upset about the fact that for the last 4 or 5 years, the Indian auto industry as a proxy has been stagnant at 2.6 million cars, thereabouts. And instead of expanding our number of cars and upgrading, when I compare with China 15 years ago, we were both at about 1 million cars. And today China has gone from 1 million cars to 22 million cars ahead of US. And the average car, unlike the Alto in India, is the equivalent of a Toyota Corolla. So it's 8x and maybe 2 or 3x. So it's almost a 15-20x multiple to the Indian car market. That really gives you a boom. That then kickstarts the whole capex cycle, because people then want to produce capacity to service that demand and so on. Similarly, take the retail sector in India, the whole organized retail sector, and even if you include Titan in that, I don't think the profit, PAT, is more than 2,000 crores. This is a staggering number when you think I'm addressing 1 billion people in this country. Yeah. So that's the way I think things will eventually play out.
What about financials, banks, NBFCs?
So that's the only way to play the whole thing, and that's what the market's been moving towards. That in this country, like I said, if the saving rate was, say, 25% of GDP or thereabouts, only half of it was going into financial savings. So you have so many levers happening now that A, the GDP grows, B, the saving rate hopefully stays at 25 or inches upwards in a upcycle in the economy, and then the share of financial savings goes up. Within that, the share of the private sector at the expense of the public sector, which is today 75-25, probably flips and becomes 75 in favor of the private sector. And now you have the advent of technology, which the private guys and a lot of the public sector people have also grasped. So you can start lowering your cost base and expanding these markets. So I think the run for financial services, whether it's insurance, NBFCs, banks, microfinance, housing finance, is just spectacular. So that has to be a very, very large chunk of the portfolio. In the indices, it's already about 1/3. Yeah. But even if you were to go half over there, it's in a way giving you a play on everything in some sense. And that's really the most economic sensitive sector here. And like I said, you take 13-14 billion is the profit pool of the financials. 10 billion is IT. 10 billion is oil and gas. That's really the big profit pool in India. Of that 10, of course, 5 is Reliance, and Reliance itself will start showing you all the capacity expansions coming on stream from next year. So you already have a semblance of a decent portfolio.
So you're saying, just to summarize, that don't expect a major bull market like 2003, 2007.
Stay bottom
right
up.
Yeah. Just pick stocks and you'll be okay.
Yeah, that's right.
Yeah, and would you say that of the country relative to EMs as well now?
As well. I think we do have among the best leadership in the world. It is right, meaning sometimes the execution may not be what you would desire, but that's the trait of a leader. You take a decision instead of saying, oh, if I do this, this can go wrong and that can go wrong. So I'm less upset about that. I'm hopeful, and I just hope our country votes in the right direction, because that will signify whether we'll have more progress or we then go back and become a lame duck government, and that just then kills the whole thing.
Manish, always a pleasure. Thank you very much for talking to me today.